Well, as the global economy still looks shaky in so many places, when you're thinking about investing finances, there's oftentimes going to be lots of risk associated, and perhaps there is no time in history when it hasn't been risky making investments, but with markets going up and down the way they do, it would be good to get some insights into how to deal with the trends that happen in global markets. Gavin Martin is our finance expert and the founder of Cornerstone Wealth, and back with us today. Hello, Gavin. Welcome back to 2020.
G'day, Neil. Great to be with you again.
Gavin, this time of year, it's always good looking at potential investment possibilities. Markets go up and they go down. Is there ever a good time to actually become involved in investing in stock markets or in currency?
Yeah, I think it's when you have money that you're not afraid to lose, basically. So if I know a lot of us have money in superannuation, and we need to have that money invested, although it could be invested in term deposits. But if you're looking at other money other than your superannuation and investing that in the share market, then I think you need to think about investing money that you don't need, because it could actually go down in value significantly, but hopefully over the long term it will provide a good long-term return.
Of course, when markets fall, sometimes the wisdom is to ride out the market until it rises again. When you've got some money invested into the stock market, I guess you've got to monitor the news to find out what's happening to see how long you should persevere.
Yeah, exactly. And one of the most difficult things with investing in the share market, for example, is the timing of the market, and experts with PhDs and spend their lives trying to analyse both individual stocks and getting the timing of markets right. The evidence shows that they can't do it. The experts can't do it, and so how are we as individuals supposed to do better than what the expert are trying to do when the evidence shows that they actually can't add value in that area? So it's important to remember that cliche that it's time in the market, not timing the market, that is important.
And Gavin, how important is it to increase financial literacy when it comes to this type of investment? Because it's one thing to read the newspapers, it's another thing to actually get an education as to the science of how markets rise and how markets fall, and there is certainly a science connected with investing, isn't there?
Yeah, there are lots of different approaches to investing and theories, or I guess it's more about approaches to investing, but it's important to know and understand your approach. There's a book, I think it's by Charles Ellis, who he wrote about people just having their theory and knowing that it works. There was a particular farmer that when there was a particular climate in the market, he knew that at that point in time he would come to town and he would invest his money that he's generated from his crop in the market, and he knew at that time each year he would go and invest his funds. So you need to understand what your investment approach is, whether you're going to actively buy and sell shares, or whether you're going to or other investments for that sake, or you're going to buy and hold. And it's really important to understand what your personality is and to work in with that and make sure you don't get caught up with the emotions of investing along the way.
If you're investing in the stock market, as you say, you look at your own personality, the sorts of things that you're attracted to. So if I was interested in the mining industry, or in steel, or in agriculture, or all sorts of other areas, if I had a particular interest in one of those, would that be an area that I perhaps might do better in if I was being able to gauge the market?
Yeah, exactly. Use any of your own knowledge to your advantage. But getting back to that question about what's the best way to learn, I think the best way is actually putting your toe in the water. So if you've got an expertise in the mining industry, then put your toe in the water and buy some shares in the mining industry, and have the experience of receiving the dividends, seeing the value of the stock going up and down. That was one of the crucial things that helped me learn about investing. Was early on when I had a supermarket job at 15, putting part of my weekly salary into a share, and into a company buying shares. And that taught me so much about dollar cost averaging into the market, understanding how companies worked, that their voting mechanisms. And so I think the crucial thing is to put your toe in the water to understand actually how it does work.
How does that go as a parenting tip as well? Is that something that you say to parents who have teenagers? Maybe you can gauge whether they are, financially interested in investing and when it comes to stocks and shares. Is that something that you encourage parents to do with their children, with their teenagers?
Yes, parents or grandparents. Often it's the grandparent that wants to put $1,000 or $500 aside for a child. And I say that's fantastic. You can put it aside, but don't miss the opportunity to teach the kid about investing as well. It's so important. We were just driving on a toll road the other day and the beeps were going off. And the kids were saying, "What's that beep? And does that mean we're getting some money?" And unfortunately, it wasn't us getting money, but us paying out money. But that then led on to a whole conversation about, so where's the money go, and can I get some of that money? And so we talked about the fact that it's a company, and that if you owned a share in that company, then you could, every time all the cars beeped on that road, you would be entitled to a portion of that money. And so then they say, well, how much do I need to invest? And I said, you might buy a share for $20, but it might cost you $20 in brokerage. So you really need at least $500 or $1,000 to invest to make it worthwhile doing that. But our little 8-year-old really got the concept, and I think he's going to start to put his money towards being able to buy a share in a company at some point in time.
Gavin, in this low interest rate environment that we have in 2013, what does that mean for people investing in the share market? Is that a good time to be getting involved in stocks and shares? How does that affect the market ultimately? Is that a typical thing that you think, that interest rates are low, I could put my money into a term deposit, but that won't get me much. What if I go with shares?
Yeah, very good question. As interest rates fall, it means that there's two sides of the coin. There's people who have term deposits that are coming to maturity. They might be earning 6% because they invested it a while ago, and they might now only be able to get 3 or 4%. And so then the question is, well, do I just accept 3 or 4% when inflation is close to that level anyway? So I'm not actually going to make any money if you have to pay some tax on that money. And so then people with those term deposits maturing start to put their money into the share market because they can maybe earn a yield and fully franked, so they get some other tax benefits of 5, 6 and 7 and above %. And so that starts a movement from low yielding term deposits across into the share market, which then can produce a rally in itself. It can actually increase the valuations of companies. So that's one way that low interest rates help produce a market rally, the share market going up. But it's also the fact that companies are able to borrow money at lower rates as well. So rather than raising money via the share market and going out to investors and say, can you give us, buy some shares so we can have some money to go and invest and produce a return, they can actually just go to the bank and get a lower cost of capital. So paying 3 or 4% interest rather than having to pay 5 or 6% in dividends. So there's lower borrowing rates for companies, and that then enables them to produce a higher return and can increase the stock market. And then the third factor is that as people are analysing stocks with lower interest rates, there's a lower discount rate. So it's hard to explain that, but it's basically saying that if there are lower interest rates, for you to get a reasonable return, the return doesn't need to be as high as it was previously. And so therefore that can also mean that it's attractive for people to buy the stocks as well, which then produces a rally. So there's sort of a threefold implications of lower interest rates that can cause rallies.
And we don't really have time to talk about interest rates and the property market, but we might save that for another day. Gavin Martin is the founder of Cornerstone Wealth. Gavin's website is www.cornerstonewealth.com.au. Gavin, always good getting your insights. Thanks for being with us today on 2020.
Thank you, Neil. Great to be with you.